Good morning, ladies and gentlemen. This is Student Say Trading Frank, and after a long, restful weekend, we're back in the game here on April 17th, 2017, approximately 8:37 a.m. right now, at the onset of the tech earnings season. And I'm going to be scrolling through a few charts, which I've already posted on my real-time Twitter feed, but just kind of do a walkthrough on a few things. I'll keep this short, probably about 20-25 minutes. So everyone will have a chance to quickly glance at it. Most of the stuff is pretty obvious to us, what's going on. We are in a very tricky environment. Volatility has been rampant, and despite all that, we've managed to make some pretty substantial profit on selective stocks, and that's the way it's going to be. This is not the type of market where everything is correlated. It is not the type of market that every single stock in a sector is going to be up on the same day, and you're going to see a lot of unhinged sectors on different areas which are going to act differently on a certain day. Look, this is not an easy market. I've said that for a long time, but now it's become far more difficult. For that reason alone, I rely very heavily on my tactical algo HFT charts, the Thinkorswim charts that you're looking at, the investing.com charts that I structure, and all the structures that I draw over it. Most of the times, as far as I can see and my backtesting work, the points do get engaged. Now, during the day, when there's intense volatility, you have to figure out a way in between looking at those charts and how to manage your trades. If you have profits and you sit around too long, especially for active trades, it's going to be gone. And that's just the way it is. There's nothing anyone can do to control that. As long as you embrace volatility, as long as you're prepared to face that this is not an easy market, you're going to be fine. And I've proven that over and over and over again. Straight talk doesn't sound too good. When a coach is trying to teach players on a particular strategy, on a particular set of new rules, or a different way of looking at the game, it's not easy. I understand that. I try to do that to myself all the time. I try to help out my members and free trial subscribers by telling them the straight facts and the truth. And sometimes, it's not pleasant. But there's nothing I can do about it. That's just the way the market is. Saying all that, exercise discipline, and that doesn't mean rigid discipline. You have to be flexible. You have to be flexible. You have to keep trades within a reasonable size, and you gotta act on it fast if they are fast trades, or if it's swing trades, you gotta have the patience to wait. There is no easy answer to this market. At the same time, the markets are very technical, and these charts have delivered some very strong results. And the more you get used to them, the more you train your eyes to look at them and talk to your brain, the better off you're going to do. These are not just platitudes and words of comfort and preaching that I'm doing. These are the facts that deliver the profits in my trading portfolio, and many of you are using that same approach that I have taught in the advanced coaching sessions and daily through my real-time Twitter feed, and also doing well. But at the same time, you've got to take your losses if needed, and then you got to make it up somewhere else, just the way it is. You cannot just sit in a position if technically it's not cooperating and then hope that it's going to turn around. In many cases it does, but maybe it's going to take a lot longer, and maybe it's going to erode your confidence where you cannot make money on the next trade. Enough said about the behavioral game theory stuff. Let's get into the charts. Here's your S&P 500 as of the close on Thursday afternoon, and this chart has been shown repeatedly, and you can clearly see what's going on. This line here is a very critical support where the last bounce happened on March 27th, and that's around the 21, I would say the 2320 level. It shows here as 2321.47. I have an arrow there. You can see that. Failure of this line here brings the next level of support into play. That's 2300, give or take 2300 or 2301. That was the previous breakout of this minor bull flag, and that was this upper bull flag, and that was back on the 9th of February. That's the next engagement point on the support side. At this point, I'm just showing you the downsides, and then I'll show you the upside. This is the S&P 500. So these are absolute numbers. You do not have to adjust them as you have to do for the E-minis. If we lose the 2300 level, we're going to see a very sharp move quickly down to 2266. Keep in mind as you're listening to this that every S&P point is roughly 5 to 6 Dow points. So a 30-point drop from here to here is basically roughly about 150 to 180 Dow points that you're going to see a quick fall. That is a major support in my opinion, because that was also another level of breakout, but more importantly, that acted as a substantial support level with a double bottom, almost a triple bottom, and that's at 2268. The stop below that is at 2232, and that was also a pretty critical support back at the end of the year 2016 on December 30th. So at this point, if you look at the structure of this, it's certainly acting like a head and shoulder. You got a head here, you got a right shoulder here. Here we go. Okay, you got it. I'm just going to do it with this. Okay, so you got it. You got it. Right shoulder here. You could call this say. The only problem with this is this is actually more of a double top, because there's a call it double top. Take out the head and shoulders pattern for a minute here, because the left shoulder is not evident at this point in time. Some people can call this a left shoulder. I wouldn't. Whatever the case, it's a double top close to that 2400 level or so on the S&P 500. This is what's getting played on right now. You got a spinning top naked bar. That's an inverted hammer. That's an inverted hammer. When the tail of the hammer is basically a long tail, and the head and the body of the hammer is lower. It's a hammer falling, right? So it's an inverted hammer right there. And here what we're seeing here is I don't know what type of pattern that is, but it could play out in two different ways. It could possibly be a dragon bullish, where we touch this 22-20 level and then jump higher and basically create a W pattern. And the levels of what I consider to be, and these are really important because this is exactly what's getting played out in the market. This is what's rocking your daily trading portfolio or your swing portfolios back and forth. So it's extremely important that you understand these levels. So if on the upside, if this is true, if it is a W pattern or a dragon bullish pattern, I'm looking at it from this level here. This was the big flash crash. Then the most you can get up to is 2382. 2382. That's roughly about 60 points from here. A little less than that. So you're talking about about 300 points in the Dow. That brings us up to into the 20,800 level or so on the market, on the Dow Jones Industrial Average. More importantly, what I think from a tactical trading point, you got a couple of things at play here. Let me zoom in, and this is what we need to concentrate on. This 5-day SMA is pointing down. It's acted as a daily resistance. You can see that. We've tried to cross over the 5 SMA and we have failed. We haven't closed above that. So the 5 SMA is critical. That comes into play at 2348. Any break over 2348 engages the market at the 50-day moving average, which we have lost for now, at 2352. I'm rounding off the decimal. At 2352. So at 2352, you're going to see massive resistance. Okay. If you climb up above that, it's going to be a powerful move, a short squeeze, and that's going to bring us up to the 2363 level, right there. And I think that's what's going to be the play over the short term. That short term could be a couple of days. It could be, I would say, the end of the week, or possibly the end of the month. I would say by the end of the week, a move like this on favorable bullish terms in the market would bring us up to engage the 34 SMA simple moving average at 2363. Keep in mind that my eyes are looking at these lines starting to curve. Now that's a bad sign. That means that over the coming month or so, we will most probably get a correction that's going to bring us down towards these downside levels that we talked about. Engaging this magenta line, which is used by hedge funds, it's a 150-day moving average, and that's at 2250. So bottom line is, these lines will be engaged, in my opinion, in May, and we should be very aware of that. Also keep in mind, as I'm discussing these levels here, that the middle of the month, which I've always talked about extensively in my videocast, is the most turbulent part of the month. right? This also happens to be tax year. So tax day is actually on the 16th, which is, I'm sorry, the 18th, tomorrow, because they've given a little grace period because of the weekend holidays. So the bottom line is that you're going to see that part of it comes from the turbulence of tax selling that a lot of retail have to make in order to pay their taxes. So the bottom line is, this is not unnatural that the middle of the month, mid-month, we have had some substantial volatility in the form of these two red candles. Keep in mind that this is the daily chart. Upper end, like I've told you, 34 SMA, 2362, 50-day moving average, 2351. Very critical that we recaptured that on the long side for the bulls. And then on a very short-term basis for quick, fast SPX trades and such, you're looking at 2348. That's the 5 SMA that I use consistently. If you look quickly at the internals, if you look at the full stochastics, you're going to see that it is coming down towards the oversold levels. And at this point, I would say that if we get down towards 13, visually you can see that it's diving there. Then obviously that's going to become a very sharp buying opportunity. Whichever the case, it's touched the lower end of the scale. That's the 20 RSI. Also on the stochastic, full stochastics, right in that range. Last time that we came down here, we started to create a positive divergence, and 2 days later, the market ripped up. So we'll have to keep an eye on that. All right, so that's enough of this chart. Let's take a look at this. That's your active E-mini chart that I've traded off many times, helped many people make some very decent money, and this is going to be in effect today. So the bottom line is, you got a lower end on the E-minis at 2315. Futures are up roughly about 4 points here, 3.75. And of course, the imminent threat of the North Korea nuclear bomb stuff is now somewhat shelved. You never know what happens out there at any given time. And so we have to be, very cognizant about the fact, very aware of the fact, and and keep an eye over our shoulders what kind of news flow is coming out of the Korean Peninsula, because that they could just do anything at any point, and then we have to retaliate, and that's just going to send out another spiral of market declines. So, but at this point, from a tactical standpoint, this is what we're seeing. We're seeing this round move here. We're engaging the 34. Short-term players who like to make 40, 60%, sometimes 100%, very fast on the SPX trade should be looking at the 2335 level. That's a 50 SMA on the 1 hour charts. I use the 15 minutes. Sometimes I look at the 5 minutes, but 15 minutes at 1 hour and the 4 hour are excellent for intraday traders. Fast traders can use the 15-minute charts, but they're very noisy. So anyway, you've got a downtrend line here. That's at 2347. We've been rejected off that on Wednesday. Wednesday the 5th, rejected off the downtrend line again on the 10th of April. Rejected off the downtrend line again on Wednesday, this past Wednesday, on the shortened week. Rejected off the downtrending 50 and the 34. So let's see what happens here. I've a small position on the SPX calls. The market opens up here, maybe a little bit higher, maybe up to this level. I think the squeeze coming to is 2335. I'll sell it. It's just the way it is. If you look at a pattern, some bulls will say, hey, this looks like a very large dragon bullish. The only problem is, well, it's not a problem, but still, we've never engaged the 2315 level, which would basically complete this pattern. Whichever the case, if we do move from here and we tend to hold this level of 2322 or so, which I clearly showed on my charts all week and also on Thursday, then we should get a bounce towards a zigzag bounce, of course, towards here and possibly to 2370. 2370, in my opinion, creates on a short-term basis, this is your head, this is your left shoulder, this is your right shoulder. Creates a massive resistance. There's resistance here. I've kept on showing these. Every single points of supply where the market turn is a point of resistance. That's where the sellers are, the automated sellers are in. So I'm tracking that real closely and sharing that with you so you guys can manage your trades. So that's where we are. Okay? And bear with me one second. So, all right. So you can see here, there's a pattern. There's a lot of zigzags, and the zigzags are where the fast traders come in and play my tactical charts. It's not that hard to understand, but it's hard to manage. If you're fast, if you know what you're looking at, you can understand the downtrend lines. It's basically training your eyes to look at these, look at the E-minis. Remember, I don't manufacture these charts. These are actual price movements on a daily basis intraday. So if you can understand candlesticks and how move and how fast they move, and remember, speed is key. I mean, these machines are so fast it makes my head turn. And so I keep my position sizes reasonably small so I can get out of it, or if they fall really hard, I can cost average down. Because I know my parameters of what the levels of risk and reward are, I can manage my trades better than anyone else out there. And that's really the truth. And that's what I share with you guys. If you know what your parameters are, you're going to basically manage your risk. You're not going to get, just terrified. If you don't know what you're doing, just watching prices and not looking at a chart, not looking at the minis, not looking at the SPX, then what can I say? It's the same old story. You're just going to be flying blind. All right, so now let me go out to the investing.com chart and bring this in. Okay, that's better on the screen now. So this is the flash crash version that I've shown many times. It's a little bit compressed in the screen, but you can see that. So this gives you the bigger picture of what's going on. This is where the flash crash started, up in the 2375 level, back on March 21st or so. And for a full month, we never got back to it, right? Almost a month. This is April 21st coming up. We just, we did get back to it, and that was back on the first part of April 5th. And this is what the volatility structure is right now. This is where we are as I speak right now, with futures up roughly about 4 points. If this pattern symmetry plays out, you're going to see a surge up here towards what I consider to be, again, the levels we have to contend with, that downtrend line 2348. Now these are on the actual E-minis, so these are very important to look at too. And if this pattern does play out, then hopefully we can get up towards the 2375 level by the end of the week. That's dependent on a bunch of major economic numbers coming out, earnings coming out, all kinds of stuff. As a reminder, Netflix is tonight, definitely going to play it, probably do a straddle with a long bias, and we'll take it from there. Remember, earnings can be extremely rewarding, or if you're stupid and you buy a lot on one side of the picture, whether the short or the long side, you're probably going to lose money. So playing it small can get large. I buy deep in the money type of calls, buy a straddle, close at the money, so that if the stock does fall, you can make, you can offset some of your losses. And remember, you're going to see intense volatility after hours. Just because the stock, let's say the stock falls 20 points, doesn't mean it's going to remain 20 points. We've seen that happen over and over and over again. So, earnings, I love it. It's a chance to make back some real decent money on some trades that didn't work, and at the same time, you learn how to trade after hours. You can buy one share after hours to see how it works, and believe me when I tell you, nothing in life is more rewarding than learning the skills. You cannot sit there and expect the world and markets to bend to your wishes of what it wants to do, even though we all want that. You've got to attack it. You've got to learn the process of volatility. Saying all that, you clearly see what's going on. There's really nothing much to say here. I follow the stows here. This is a 1 hour stow. It's showing that it's straight up into the overbought zone here. It could move sideways. It could come back and reset. We don't know. This is a level of major support. Resistance, which was a level of major support for the last couple of days, for last week, which is somewhere in that range of 2333. So if we blow over 2333, we break out over that, then this region comes into play. 5, 10-point moves, 15-point moves on the S&P 500 are extremely rewarding for SPX traders. Okay, it's like a stock moving 5, 10 points. I mean, what more could you ask for? Again, rejections can be furious. You can hit this level and immediately fall. And that we've seen that happen a few times last week as the market intensified to the downside, even though there were pockets of nice upside profits, and then the resulting fallouts. The battle zone, you can see the battle zones here. These are the battle zones. They tried to hold the support, 2333. Nice candle was developing, and then bang, big selling comes in. And by 4 o'clock, this is where we were. This is where we are right now. So I would say a snapshot of the market from the 5th of April till now, and I've already posted that. I'll be posting it again this morning. Would be a great tactical roadmap for traders to manage. Bollinger's in play here. The upper Bollinger right now is 2334. Give or take a point from exactly where this major resistance is. You know, that's how it works. Mid Bollinger's the line here. That's your major downtrend line. That's your sort of the bear kill zone in this zone. We'll see if we can get up there. If we break this downtrend line at 2348, then you're going to see a very fast move up towards 2364. On an ending note, all I can say is this is a very fast market. In the meantime, we have still done extremely well in many stocks. Chipotle, I mean, it's all there. You can see. Now I had a long weekend with family, so I don't remember everything on top of my head, but you know what I'm talking about. Multiple winners. Oh, of course, Tesla, which has just been huge. And I've constantly kept on posting the charts. Do not spread your positions in too many. Do not spread your trading positions in too many stocks. Try to stay selective. Use your own judgment as to how many you want to be in. But focus on the ones that you're in. All that. So that's it for now. Have a great week. I look forward to a terrific week. God bless you all. You all are great. And all I'm trying to do here is be a faster messenger of the market and provide you with the tools that you need to build your own house. I cannot do that for you. Have a great week. And see you in the market in half an hour. Thank you for listening.